So Euromoney is a business-to-business information business. It's very much focused on delivering key information that helps people run their businesses efficiently. It's got three divisions: the asset management division, the pricing, data and market intelligence division, and the banking and finance division. Of those three, the pricing, data and market intelligence business is the largest of the segments at 42% of last year's turnover. And it was growing at a very impressive rate of 18% at an underlying basis. One of the most interesting things about this business is the high level of subscription and repeat revenues within the organisation. 56% of last year's revenues were in the form of subscriptions, and the events business is also a large contributor. And again, that has very attractive cash characteristics. Over the last couple of years, there's been much more intensive portfolio organisation within the business, actually looking to drive the operations forward. Management have a terminology for this. They talk about 1.0 as having been media original businesses, the traditional print magazines, that sort of type of organisation, and then moving on to media 2.0, which would be online equivalents and digital operations that work with customers alongside them. What they're very much trying to do is to move their businesses more to what they term the 3.0 media organisation, where the information is actually embedded into the customer's workflow. It can be then moved on from just a transaction price, which would be within 1.0, buying a magazine, something like that, through subscription, which would tend to be the revenue model in a 2.0 business. But as a 3.0 business, you still get subscriptions, yes, but you can also move through into licensing type revenues, and even where the output of their operations is a pricing structure that can be incorporated into, say, an exchange pricing, price reporting, that could even be a commission on the exchange fees. So these businesses have very high cash conversion, and over the last 16 years, the group has averaged over 100% of converting operating profit into cash, which is obviously very attractive from an investment point of view. And at the last balance sheet date, there was quite a considerable amount of cash on the balance sheet, some of which has since been spent on the recent acquisitions of Bordex and the deal, which led us to modest increases to our revenue and earnings forecasts. As at the end of FY19, which will be in September this year, we're forecasting cash on the balance sheet of 74 million. But as I say, the portfolio activity has been much more active, and there are banking facilities in place which will enable them to spend more on acquisitions if they find the targets that are suitable and that fit into this ideal of price discovery, where it's integral to a customer's business flow, where it can be moved into a 3.0 business, and it has attractive operating margins. So why is this interesting now? Well, we've recently heard from DMGT that they have been reviewing their strategic options for Euromoney holding, a 49% stake reduced from 67% in December 2016. They have now actually clarified what they intend to do, and the answer is going to be a distribution to the DMGT shareholders, bar the Rothermere family, who are not participating, which means that the shareholder base will be spread amongst existing Euromoney shareholders and adding in DMGT shareholders who weren't previously Euromoney shareholders. That should increase the liquidity in the stock quite considerably. And because it will go up effectively to 100% free float bar the management holdings, that also means that index tracker funds will now be able to take a clearer position in the stock and not just be restricted to the 49% weighting, which could be an interesting catalyst for a re-rating of the stock.